at retails. The big winners today and the big winners since the December market lows. Energy and retail now both up 14% since then. Typically, higher prices in the energy complex lead to pain for the consumer. So can this retail rally really continue if we see strength in energy continue? And what does this mean for the markets, Guy?
I think the strength in retail can continue with crude oil rallying. I mean, you go back to this summer, names like Nordstrom's, Macy's had tremendous runs when crude was still probably in the later stages of its upswing. So I don't see any reasons why they need to be mutually exclusive. And in terms of setups, I'll let Tim speak to the energy portion, but in terms of retail, you look at a name like JW Nordstrom, which unfortunately reports towards the end of February, so you got a lot of time, but you look at where it just traded down to $45, held exact low we made back in May, seems to be bouncing, valuation is reasonable, and names like these are trading names. Like, I don't think Nordstrom's has figured out all their problems, but the move from 65 that we saw, a few months ago down to 45 was probably too much. And I think you can see on a benign tape, and we'll talk about the broader market later, a rally in retail.
Well, retail, so the XRT, if that's your measure of retail, at least as a proxy, is outperformed the S&P by about 7% since I think it's about 7 days or a couple days into last year through to where we are. The holiday season was extraordinary for retailers. The other dynamic, we're going to talk about credit a little bit later in the show, but I do think that a handful of these retailers are credit stories. And so you've seen at least the combination of very good backdrop on holiday sales and also a better credit environment, making a lot of these oversold names look interesting. I still think Best Buy, which trades always cheap, is very cheap relative to itself in this recent run, had another big day today. And I think retail is the place you stay.
But what has changed, I guess, is not a lot since last week. I think the most positive thing is Powell. So if Powell is dovish, the market can run. I think it's all technical. I don't think it matters.
And everything runs, that means?
Yeah, I think everything runs. I think the things that gotten beaten up, retail, energy, that's what you're seeing pop, large cap tech. But I don't think it really matters on the whole.
But Powell's not technical, right? I mean, isn't Powell a discussion about rates and the Fed
balance
and how
sheet, the rates, but it's all talk. I don't know what reality is just yet.
Yeah, Karen.
I mean, retail, it's really nice that it bounced. It shouldn't have been where it was, right? There's so many good things that have happened in retail in terms of employment numbers. You talked about even with even with oil up, gas prices are still very low. People are employed, wages are going up, and the valuations on a lot of these names, I think, were really overdone. So it's nice to have this one-day rally. But I agree with what you're saying. I think there's still legs here because the multiples on a lot of these stocks are well below the market.
They got so beaten up, but just think about what's going to be late. The refund checks are going to be late with the government shutdown. That's a lot less money in the pocket of consumers. Maybe that's a headwind going forward. But for now, I think you're okay for a further pop, but that could be a headwind. In
terms of the psychology of the consumer, though, Guy, I mean, we were talking just last week about how all the market volatility can really grate on the psyche of the investor. And then at the same time, if you see prices rising at the pump, Isn't that a headwind at all? I mean, a little less money in your wallet every week because you're filling up the gas tank?
I think the market volatility is the key. Listen, gas prices, I think we've become conditioned to see gas rise and fall over the last decade or so. So I think the U.S. consumer is okay with gasoline at these levels or slightly higher, number one. Number two, though, is a more salient point. I think the volatility in the market, I think, scares people, and a scared consumer is a consumer that won't spend. Now, we've seen an 8.5%, 9% bounce from the low over a holiday week. Maybe people are saying, that was it. 2019 is going to be great. So maybe their confidence can come back if we see a tape that continues to sort of grind sideways to slightly higher. I happen to think that the market movement is far more important than energy movement.
It is more important. I trust that, and I believe that. I think that when people see the market and their net worth evaporate, they really don't want to spend, obviously, right? It's human nature. But I also believe that this rally, this pop, is going to be short-lived because there's nothing fundamentally that has changed in my mind.
Let's say this rally is all trade, which it seemed to me that it is.
All trade?
Trade related. The hope that there's trade.
But I'll let you keep going.
All right. Thank you. Let's just say that's all
I think he's going to disagree with you when you're done.
I sense that.
But I'm laying back.
If it's all trade, which I think it is, do you think that we have to see something in the near-ish term?
I think you will see something.
Maybe we will. I hope we will.
I think you will see something, and that's going to be the last pop or the last rally in this bounce relief.
Or it could be the biggest headwind to the retailers who are going to face a rise in tariffs come March. I mean, right? I mean, they have
If we don't
90
get a deal done.
days,
If we
right?
don't get a
If
deal
there's
done,
no
right.
deal done, there are real consequences at that 90-day mark of tariffs going up.
To the market, I think,
to
as
the
well.
markets
and to businesses.
retailers
So
specifically.
I think that's fair. I think we're going to get some kind of an announcement because I think this administration needs some kind of an announcement. I'm not sure how substantial and certainly how constructive it will be to the structural issues here. But I look at what's happened in the last 48 or 72 hours, and while I don't think what Fed Powell said on Friday was any really that different than what he said 2 weeks earlier, I will acknowledge that the balance sheet was given more of a context for them being flexible.
Why do you think we rallied?
We're now using.
That was the whole
point of the rally.
I understand that. So why are we talking about trade? As if trade is really the dynamic here that I think is going to give
another tailwind.
Well, so to me, the Fed is the only thing that matters right now. And if you have a dynamic here where the Fed is actually saying, look, in the short run, we're going to let this thing breathe as often as it needs to or as much as it needs to. That, to me, is so much more important than trade. I think that is what's weighing down the market.
Let me disagree with you.
Please.
I think if we were to see a headline tonight, like, you know what, the U.S. contingent has come back and talks are off, and we currently plan on March 1st or whatever the date is, we're going to implement those tariffs. That market will be down a lot.
Okay, so let me throw another scenario at you, or another hypothetical. What if we heard tonight from Fed's Powell or a handful of the Fed committee members that are voting members that actually the Fed is concerned and is actually going to be more hawkish than we were misinterpreted over the
hawkish?
More hawkish.
Okay.
In other words, I think the market would sell off a lot more on fear of Fed than it would on fear of no trade. But we can agree to disagree.
All right.
That's an interesting.
We won't know.
Mind bend.
I think the Fed's
Yeah,
the most
exactly.
important thing right now. I think central banks in the world are the most important thing.
The problem
by
is,
far.
I've been saying this, and I'm not going to pat myself on the back, but I've been saying this since October 3rd, that it was the balance sheet. For me, it was that was equivalent to raising at every meeting along with raising. So it's a double raise basically at every meeting. So now if he backs off the balance sheet, because we all know he's going to be data dependent, but if he backs off the balance sheet, that is the biggest thing for the market.
This all goes hand in hand, though. I mean, I think the concern is the Fed's reaction to what's going on around it in terms of what the macro is, and part of that equation is what is going on with trade. So, I mean, if you are a believer that economic growth will likely slow, earnings growth will likely slow this year in 2019.
And I am.
And on top of that, you have the potential unknown of a trade war. And then on top of that, you've got a Fed that you thought 2 months ago was on autopilot. That's a cocktail for disaster. But if you have a Fed who suddenly backs off, even with these unknowns out there, trade, right, then all of a sudden it makes it a little bit better.
Isn't that what we've just had? I think I agree with you. I think the Fed is.
One is a bigger thing
To me,
than the
it's
other.
much harder
it's
to
a
run a
reaction
business.
to.
It's much harder to run a business to worry about trade and supply chain and tariffs than it is to worry about a 1/4 percentage point increase.
Yeah, but the Fed is a constant. The trade can be resolved, as we'll see, whether it's going to be resolved or not be resolved in short order. But Powell, with a hawkish stance, that's pretty much as long as Powell's going to be there. I think that was the
trade issue goes away. They sign an agreement tonight, Guy.
Oh,
where's the market?
Then all of a sudden, where's the market? But also, do you think that the chances of a recession get pushed off? Do you think that economic growth, the decline that we'll see, is going to be lessened because of the trade issue?
So I'll try to answer both your questions. I think if that headline comes out tonight, I think we trade up to 2710 in the S&P. That was a level that we talked about for a long time over the summer into the fall. So I think that's the level we test on the upside. To your question about does it take recession off the table, again, I believe that recessions are caused by market sell-offs. So if I believe that, my answer to 2710 means a recession is less likely.